Brad Williams, Frugal Finance, mortgages. Mortgages come in all kinds of different sizes, shapes, and forms. You have a first mortgage. You could have a second mortgage. You could have a line of credit. You could have a construction loan. You could have a home improvement loan. You could have a third. You could have a fourth. You can even have a hard money fifth. If there's enough equity in your property, there's always money available. It's just how much are you willing to pay for that additional money? What is a second mortgage loan or junior lien? A second mortgage or junior lien is a loan you take out using your house as collateral while you still have another loan secured by your house. For example, if you're a first-time home buyer, you don't have a sizable down payment, you can use a first-second combination in order to buy your house. In some cases, you can borrow up to 95%, maybe up to 97% of the value of your property, depending on, and I say this time and time again, your credit score. If you have a great credit score, you have some cash, and you have favorable work history with increased income on an annual basis, then you could most likely qualify for a 97% loan to value. The second could be the 23% above your 80%. In other words, let's say the lender's going to say, well, we're only going to lend on a first 80%. Then we're going to attach a second for the next 27%. Combined, that's 97% of the loan. Some cases, Fannie Mae may have just a one package deal, 97% loan to value, where you're going to pay a sizable mortgage insurance. Why do they hit you with that mortgage insurance? Because they're assuming all the risk. But there's other deals where, for example, you only have 10% down. You could borrow 80% on the first, and that second could be 10%. I don't recommend a HELOC, but some people do. Home equity loans and home equity lines of credit are common examples of second mortgages. Some second mortgages are open-ended, meaning you can continue to take cash out up to the maximum credit amount, and as you pay down the balance, can draw again up to the same level, similar to a credit card. And other second mortgage loans are closed-end, in which you receive the entire loan amount upfront and cannot redraw after that. For example, 80-10-10 deal, that's common language in the industry where it's an 80-10-10 loan. And if you're an outsider, you're going, what are you talking about, Williams? 80% first, 10% second, 10% down on your part. The term second means that if you can no longer pay your mortgage and your home is sold to pay off the debts, the loan is paid off second. There's not enough equity to pay off both loans completely. Your second mortgage loan lender may not get the full amount it is owed. As a result, second mortgages often carry higher interest rates than first mortgage loans. By taking out a second mortgage, you're adding to your overall debt burden. Anytime you add on to your overall debt burden, you make yourself more vulnerable in the event that you run into financial difficulties that affect your ability to repay the loan. It is important to know that a major risk with home equity loan or home equity lines of credit is that if you cannot repay a home equity loan or home equity line of credit, you could potentially lose your home because you're using the equity in your home as collateral. When you use home equity to pay off other debt, you really aren't paying them off. You're just robbing Peter to pay Paul. Some people, and I refinance so many different types of borrowers, you'd be surprised at the gimmicks people would do. They're taking out the equity in their home in the way of a line of credit, a second, and they're using that money for vacation, believe it or not. Now, it would make sense if you're taking out a line of credit to do a home improvement, not to friggin' do some ridiculous thing like vacation, or just go out and buy stuff, which then just adds to a huge burden. Then 3 years later, they call me up and they do it again and again and again and again. Now, on the other hand, people would consolidate credit card debt using a home equity line of credit. Kind of dangerous. You're putting all that burden on your house, and in the event that something went upside down, you could lose your house. People use lines of credit to buy cars. Not a bad idea if you know you have job certainty, or if you're self-employed, you know with 95% certainty that your cash flows will be able to support that line of credit. Otherwise, you're combining oranges and apples if you're a small business and you're tapping into the equity of your house. you should have a line of credit for the business stuffed away in an LLC or an S Corp or something like that. In the event that something did go upside down, at least your house is somewhat protected. The interest rate, getting back to this topic in hand, when you use home equity to pay off other debts, you really aren't paying them off. You're merely taking out one loan to repay another. The interest rate may be lower in the short term, but that's only because you're using your home as collateral. The risk is that if you can't repay your home equity loan, you could lose your home. Plus, if you take on more debt, that could make repaying that new debt and existing loans difficult. For example, taking out a mortgage to pay off a 5-year car loan may have you making payments and paying additional interest for 10, 15, or even 30 years. Be careful about trading short-term debt for long-term debt at a higher cost to you. And what you're doing, depending on that line of credit, what are the terms? Is it a 10-year instrument? So if you're using that 10-year instrument to buy a car, well, the payments may be lower, but your overall cost is going to be twice as much. Comment. Let me know if you've gone down this route and you continue to roll over and refinance and refinance and refinance, and the dog chasing its tail kind of situation. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.